Hi everyone, and welcome back to Financial Management for Small Business online course. We're up to session 5, and today I want to talk to you about business expenses and deductions. Business expenses and bills, are a fact of life, aren't they? We've got a business, we have costs, we need to eat, we need to drive our car, and we need to put a roof over our head. So it's a reality of life. And it's important to know and understand what our costs are, what our deductible expenses we can write off for tax purposes. So in this session, I'll be going through business versus private deductions, what you can and can't claim. And just a disclaimer, the information provided in this presentation is general in nature only, does not constitute personal, financial or tax advice. So there's 4 key areas we're just going to be going through today, and that's number 1 is a definition of a deduction, what you can claim, what you can't claim, and the tax implications of these expenses. Tax deductibility of costs can be a very misunderstood area amongst business owners, so we need to be very careful when it comes to getting this right, because there are penalties for incorrect reporting or deliberate fraudulent claims. So we'll be going through how and when you claim something as a tax deduction and how that will affect your overall income level. So first up, what is a deductible expense? A deductible expense is an outgoing that has a direct connection with income producing activities of you as the business owner. So it's something that is not private in nature and it's something that can reduce your taxable income. So you also must have spent the money yourself, and you mustn't have been reimbursed by someone else. You must have a record to prove this, so in form of a invoice receipt or a credit card statement. And the Income Tax Assessment Act, specifically in section 8-1, which is the definition of deduction, states that a deduction is allowable to the extent it is incurred in gaining or producing the taxpayer's assessable income, or it's necessarily incurred in carrying on a business. And that business is for the purpose of gaining or producing taxable income. So the expense that you pay for and claim must be directly related to the income you've produced. So in its simplest form, for example, a retail shop owner buys a soy candle for say $10 and they sell it for $20. $10 is the deductible expense because that's the cost of the good that they've sold. It's directly linked. A professional services business, for example, might pay $3,000 for staff training to upskill their employees in like areas of technology or government laws or leadership skills. And that $3,000 is deductible to that company or that business, because these expenses directly correlate with the sales or income that they're going to receive while those people are running their business. And when we think about all the different things we need to spend money on in our business, we'd be forgiven for thinking that absolutely everything's deductible and claimable as an expense, but unfortunately not so. Many items can fall into the category of private or personal use, which are not deductible, or if they're of a capital nature, which simply means they must be claimed over a period of time as depreciation instead of the one financial year. So for example, general clothing is not deductible because clothing to be a deductible business expense has to be like a safety type wear or a specified uniform, or it must have an ATO approved logo design, which is stitched into the clothing. Jeans and t-shirts or even corporate wear like suits and dresses are not deductible because they come under the category of general clothing. Prescription sunglasses are not, or prescription glasses are not deductible because they all fall under medical and private health insurance banner now, and medical expenses of any form are no longer deductible through the tax system. Home utilities such as gas and electricity, if you operate a business from home, you might be able to claim a percentage of your gas and electricity or your internet or your phone bill, as long as you keep a log of the amount of hours that you work from a dedicated home office space or a workshop space. And the best idea is to get a square meterage of the office space or the outside workshop that you use for business purposes. And that's how we calculate the percentage that we can claim on these sort of deductions. Superannuation is a deductible expense when paid for employees. And as a self-employed person, you can claim up to $25,000 per year as a deduction. So what can you claim? The 3 golden rules for what we accept as a valid business deduction. Number 1, the expense must be for business and not private use. If the expense is for a mix of business or private use, as I explained, like with the home office situation, you can only claim that portion that is used for the business. And again, you must have records to prove it. What you can't claim. There are some expenses that are not deductible for businesses, such as things like entertainment expenses, traffic fines, speeding fines or red light camera fines, not deductible. Private or domestic expenses, such as childcare fees, clothes for your family, home loan payments or interest expenses, things relating to income that are not accessible. So if you earn money from a hobby that generates a low amount of income, then you can't claim deductions against that. So, you can't claim your golf club membership or a trip in a hot air balloon unless you actually derive income directly from those activities. Greg Norman might be able to claim his golf clubs, but most of us probably can't do that. So you can't claim casual general clothing either, as I mentioned before. So when can you claim your deduction? So the type of expense, whether it's an operating expense or a capital expense, determines when you can claim your deduction. So generally you can claim operating expenses such as things like office stationery, rent, insurance, and general running costs of your business in the financial year that you have incurred them or paid for them. Your capital costs such as machinery and equipment, so big things like, large costs such as cars and vehicles and plant and things like that can get depreciated over a longer period of time. And it just means that instead of, if you've paid $50,000 for something, that you claim it over 5 or 10 years, not $50,000 in 1 year. So the operating expenses are generally incurred when you've got a legal obligation to pay for those goods and services. An invoice is not necessary for an expense to have been incurred, but you do need to have a record of the expense. So as I said before, it could be in the form of a receipt or a transaction in a bank account, something like that. If you use an item in your business for only part of the year, you generally need to restrict your claim to the period it was used for in your business. So again, we're just claiming proportions and percentages determined on how long we've had it for. So how do we claim our tax deductions? It actually depends on our sort of business type as well. So in a previous session here, we talked about, trading in the right entity. So if you're a sole trader, you can claim the deductions in your individual tax return. There's a business and professional items schedule there, and you can do that through My Tax Online, or as I've always said in these sessions before, that you need to use a registered tax agent or an accountant. If you're a partnership, you can claim the deductions in your partnership return. So all of the income and all of the expenses go into that partnership return, and then they get divided up, the profits get divided up between the partners. If you're a trust, the same things. You can claim the deductions in your trust tax return, and all of the income and expenses go into that trust return, and the profits get distributed to the beneficiaries. Companies claim their own deductions in their own company return. So as we mentioned in a previous session, a company in its own right and an individual in its own right are the only two entities that will pay taxes. So all the income and expenses go into the company tax return. So again, it's best to get some professional help on all of this with an accountant or a bookkeeper or a tax professional. So how does the expense actually reduce your tax bill? So for example, if we go and spend $5,000 on a new bit of equipment for our business, it doesn't mean that we get a $5,000 reduction in our tax bill. It simply doesn't work like that. It all depends on our business tax rate. So whether we're trading as an individual, a partnership, a trust, or a company, and what our personal marginal tax rate is. So I'm going to explain that in a little bit more detail now to help you understand those concepts. In the last session of this series, the next one, I'm going to be going through in more detail the government taxes and obligations. But for the purpose of this session, I'm briefly going to explain the tax rates and how it might apply to your business and claiming the tax deduction. So as you can see on the screen here, there's a lot of numbers. But what I want you to just have a look at is there's two tables. One of the tables is the individual tax rates at the top there, which say 0, 19, 32.5, 37 and 45%. They're the individual tax rates and what they're going to be currently in the next few years. And then the second table is the company tax rates and what they've been and what they're going to be in the next few years. But I'm only going to pick on two rates for this example to keep it simple. We're going to pick on the 32.5% individual tax rate. And this applies if you are a sole trader, a partnership or a trust. And we're going to pick on the 25% company tax rate. So that's if you're trading as a company. So we're going to use those examples coming up. Okay, so if you have gone and purchased a brand new multifunction printer for your office, for example, and the cost of that is $5,500, how much do you get as a tax deduction? Okay, so if you're registered for GST, let's say, for example, then the GST on that's $500 and you'll get that credit on your next business activity statement. This brings the actual cost of the item or deduction down to $5,000. And under the current rules, we can get 100% tax deduction write-off for that, for depreciation. Under some old rules, we would have to claim that over a period of time. And look, they may change again in the future, but that's the nature of the tax system. It changes from year to year depending on political parties and budgets. So if you are trading as a sole trader, a partnership or a trust, then that $5,000 will give you a 32.5% tax reduction, which equates to $1,625. So that's what you would get not as a tax reduction. So it will reduce the amount of taxes that you have to pay. If you're a company, then you would get the 25%, as we mentioned before, which equates to a $1,250 tax reduction. So I hope this stuff's been clear to you. It's just a basis of how we go about claiming deductions, what we need to really be aware of. Because again, as I said before, there's quite strict rules on what we can and can't claim in our business. And, there's heavy penalties for fraudulent claims. So I hope this has been of help to you. And again, please see your accountant or bookkeeper or tax professional for help with GST and taxes. Don't try and do it yourself, and engage with a business coach or an advisor to help you improve the day-to-day efficiencies and operations of your business, because these are valuable time and money investments. And the returns on the time and money are absolutely invaluable. So thanks again for watching, and I'll see you in the next session.